guys. This is your partner, Mr. Cosmic, aka Marab Ford, here with the Cosmic Training Academy. Um, First of all, we're not selling any financial advice. Um, we are not financial advisors. So, but we do like to show examples of what you can do. So, today I'm going to talk about options here on Robinhood. And just remember, try not to do options on, well, it's not my place to tell you where to do them at, but I can say that if your broker charges for options, then you maybe want to be careful if you have a small account and you're not doing very large account. And besides that, I really don't see why you want to pay for something that you don't really have to pay for, unless you have an issue with getting orders filled. Then I can understand why you want to do that. Anyway, here we are. We AT&T. We on Robinhood. I just wanted to show you something that I thought was pretty interesting. AT&T. If any of you guys know, AT&T is one of those long-term stocks. Um, Always check whether the company has dividends. AT&T does. You can see AT&T has dividend yields right there. Um, Also, let's look at, we got a pretty good volume, 95 million. The average volume is 53. Today's high is 2682 as of January the 5th, 2022. Um, 52-week high is 33, 52-week low is 22. Okay, so just keep that all in mind, guys. Okay, um, that 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 we that's what we're looking at. Okay, so we go down here to the trade button. We go to trade options. Now, this is what for long-term investors. I think this is pretty cool. Let's just go out to July. So right now this is January. That's July. We're about 6, 7 months in, right? Okay. So in this strategy, what we're going to do is we're going to buy calls and puts first. A lot of strategies such as well, this is more closer to like a strangle strategy. The other strategy I like to do is an iron condor, which is another four option strategy. Um, but in this particular case, we're doing more of a strangle. So anyway, it's a four option strategy. Um, and I think it's pretty cool. So what you do is you buy a call right now. It's at share price is at 26. You can see that share price is 26. The first call option in July 15 is going to be $27. So we're going to buy a call at $27, right? Okay. So first thing we do is buy the one right above the strike price. The second thing we do is we buy a put. Make sure your button's on put. You see how it turned red? We're going to go right below the strike price. We're going to buy that one. So as you can see right now, we in pretty strong. That's a long strangle. You can see where it says it right down here at the bottom of the page. Long strangle. Long strangle anyways down here. So right now, let's take a look at where we at. You go down to the bottom, you can see here it's showing our contracts. We got $27 call, July 15th. That's a buy for $100. We got a $26 put, buy. So if you knew the options of calls is when you buy a call, it's because you're bullish. If you're bullish, that means you expect to go up. Why do they call it bullish? Why do they call it bearish? Bullish is supposed to be emblematic of the horns of a bull going up, and the reason why they call something a market bearish is because when a bear swipes, it swipes downward. So that's the way you kind of remember in the back of your mind. When somebody says, I'm bullish on the market, I'm bearish on the market. Bullish means you believe the market is going up. Bearish means you believe that particular item or underlying stock is going down or the market is going down. Bullish and bearish. So when we buy calls, we're buying to call up. So that I always like to remember that when you do a call, that you call somebody up. When we were in high school, and somebody puts you, they usually put you down. So, so this is the thing. So when you doing the puts, it's for a bearish direction. When you're doing calls, it's for a bullish direction. So we bought a call and we bought a put. So we're basically buying any direction above and below wherever the underlying strike price was at. So we can go down here to profit and loss analysis right here. Profit and loss analysis. Look at the maximum profit, unlimited. I love any strategy that says the profit analysis is unlimited. The only tricky part about this is that the maximum loss that you can lose is 350 right here. So just think about that. You know, this is money you got on the table. But also remember that AT&T, know your underlying stock before you start trading it on options. You shouldn't be trading anything that you haven't already. And it's always good to kind of, if you're going to trade options, stick to a few ones that you already kind of know in particular sectors. If you like tech, you might want to be with Tesla. Or you might want to, if you like pharma, you might want to be at Moderna. But whatever it is in any particular sector, try to know kind of how that stock moves. If it's heavy, if it's not. Anyway, so I know AT&T doesn't move a lot, so I know it might take a little while for it to move. So here is the price of AT&T right here. It has to go outside of this price to make money. You see where it turned green at? That means that's we're gonna make a profit if it does that. So right here you can see if AT&T gets to $30, right now it's at 26. We got 6 months, 7 months for it to get to $30. I think we can make that happen. AT&T moves sideways most of the time, but right now we've been in a bearish market, and so thing it's really been kind of moving downward. Um, but the AT&T has been pretty good about paying dividends. I think recently, if I'm not mistaken, they actually have started cutting in on their dividends and making it a little bit lower. And I think that AT&T been making a hit, taking a hit because of that. But anyway, I don't see AT&T going anywhere, but I'm protected on both sides in this strangle, because whether the stock underlying stock goes up, I start making money. The higher it starts going up, you see that? Look at that. Look at and again, the risk unlimited. Profit, I mean, profit is unlimited. Maximum loss is 350. So you already know what you can lose before you go into this. So it's not like when people say, "Oh, options is risky." It is risky, but do you know your risk? What's your risk tolerance, and how much can you lose? If you don't have enough leverage to go over 350 right now, you shouldn't even be trying to take this kind of trade, because whatever it is, whatever your amount that's in your account, you should be able to hold that 350 for as long as for the duration. If you can't, then perhaps you might not want to trade it, or if you think that you might have to hold it to make that money to make the money, and you need that money, you probably want to take a different trade that's not going to cost you as much. Okay, so this is a live account. Anyway, um, so here we go. Um, Also, if AT&T decides to go with the direction that it's been going, which is down, we still keep making money. The farther it drops, the farther it drops, the farther it drops. We're still making money. We're still making money. We're still making money. So the unlimited profit, this AT&T, it could go to zero, and we'd be getting paid. So with the market that we're in right now, with this pandemic and everything like that, you don't know which way the stock's going. You know, you can't even predict it. Companies gonna start getting tight. They're gonna get scared. They're gonna start making crazy moves. You know, all kind of catalysts are gonna be happening. So you don't know. So I believe that when you're trading options, if you're going naked on calls, to me you gotta be crazy, because that's what I did. That's amateur shit. When you first get into the market, you start doing that because you see quick money, but you also will learn after a while. I did one-sided single calls, long calls, and long puts for a long time, and basically, effectively, it's 50-50 game, especially when you're doing day trading, because you don't really know what that stock is going to do for the day. How far can you take that hit? How far can it drop? If it dropped really bad, you're in trouble, and you got no protection. I mean, unless you got a stop loss, which you should always have, but still, you can take, how many stops can you take before you blow your account? You don't, you have to know. You have to have really good management. If your account is $1,000 and you taking the loss of $100 every day, you know you got 10 days before you in trouble. So you shouldn't be taking no more than $10 loss a day on $1,000 account, maybe $20 loss. 'Cause you got to be able to stay in the game. That's the object of the game. Like Warren Buffett said, rule number one, don't lose money. Rule number two, don't forget rule number one. Okay, so I just think that was pretty good. But check this out. This is where it kind of get funky. Now we haven't sold any options, but if you know anything about options, and if you knew that selling options gets you profit, immediate profit, a profit that you can use and go right to your trade account and you can use it right then and right there. So one of the best ways of trading options is to always is have some type of strategy where you're selling options in your portfolio. Selling options is almost like a guaranteed profit because even if you forced to have, even if you get executed or exercised, then you should be selling something at a price that you're willing to buy it at. So just remember that. If you sell anything, be willing to buy it at that price. Just remember that. That's the key. If you're selling the put, you may be willing to buy it. If you sell that put at that price, make sure that strike price that you're selling that put at is at a price that you're willing to buy it at. So if I sell AT&T, like right now I'm buying puts at $26. You can see that right there. But what if I was selling it? What price would be a good price to buy AT&T? If you sell a put, you got to think you might have to buy it. So you need to make sure that it's at a price that you would want to buy it at. Me, if I really had to look at AT&T, let's go back for a second. We already seen the 52-week high is 52. The 52-week high is 33. The 52-week low is 22. So anything around $20, I would be willing to buy it at. But that's you got to make sure your account can hold that because remember, options is 100 shares. So if you ain't got $2,200, $22,000, then you might not want to entertain that. So anyway, so that's that. So let's go back to what we were doing, the situation at hand. Let's go back trading options. We think it's going to trade sideways. We're going over here. Excuse me. I apologize about that. Oh, straddles and strangles. Interesting. Okay, so let's go back to where were we at? July, January, February, March, April, May, June, July. I think we did July 15th. So anyway, going back to that, let's do this again. So we're gonna buy a put. We're gonna buy a call. We're gonna sell a call right outside the one strike above. We're gonna sell a put one strike below our previous put. Okay, so this is a order. Four option order. Okay, so now take a look at this now. Check it out. So before our total debt was about $350. Now our total debt is $82. So $82 debt. Now you're taking a whole lot less risk. Now let's see how much potential gain you got to take for that risk. Maximum profit is only $18 compared to what previously we had with a long put and a long put and a long call. We the maximum we was able to gain was unlimited profit. Now our profits are limited. We're at $18.50. Now the question was, would you want to hold an option that long? Would you want to hold an option for 6 months just to make $18? Probably not. So the idea is that you want this thing to pop way before then. So, but I want you to take a good look. Let's see where we're at right now. Now remember, we can always execute a trade and close out our trades anytime before then. That's the cool thing about options. You could either exercise or you can close it anytime before. So you don't have to worry about it. But you just want to try to make a profit. So we know right here. We know right here that at $27, um, once we go past $27 threshold, then we start making profit automatically is $18. All you gotta do is get past $27.82. But if it drops, well, it can drop to zero. We would not be broke. We would still make a profit. So that's one great thing about this. So it's a four option strategy. It's a short game. But let's go. Let's say, for instance, you're a weekly options trader. Let's clear this up. Let's go to the beginning. Today is January 5th, 2022. Let's say we want to do it a week from now, January 14th. And let's just say we're going to do the same strategy. Here's the share price, $26.40. We're going to go ahead and buy a call right above it at 26.50. So we're going to be in the money with it moving only 10 cents. So, then we're going to buy a put. We're going to be in the money. Same thing. If it moves 40 cents down, we're going to start going into the money. And in the money means at the the strike price is going to change to at least that price. That's the way I remember it. Some people say in the money is if it's you can't go lower and higher. In the money could be higher, it could be lower. It just depends. If you're buying, it goes up and into the money. If you're selling, it goes down and into the money. So um, here we go, right here. So we got a call and we got a put. We already bought. So now we're trying to get our money back. So let's go ahead and sell a call. And we bought one at 93 cents. Now we're going to sell one at $1.38, which means we're going to have a profit on that one right there. And then we're going to sell, oh, excuse me, we're selling a put. So we're going to have a profit of about 20 something dollars. And we're going to sell a call right here. That's about a $7 profit. So here we go. Total debt cost is going to cost us to get into that trade $33. Now remember, now see the big difference now? Now this contract ends in about a week and a half, give or take. But we're making the same amount of profit as we would for a whole 7 month trade. So which one would you rather take? Now remember, you on time. You got to watch all your time and everything like that. Um, but the only difference is $2. So for that $2, why wait 6 months to make $2? And you can make that extra $2. You make $16 in 1 week. Now some people might say, well, that ain't enough money for me. Well, if you got a good account, guess what? I got a trick for that too. So this what we'll do. We'll go and edit the ratio. So say for instance you have $300 that you want to trade with. We can edit the ratio. So let's knock it up. You said you want to do more call. Okay, let's make the option not edit the ratio, but actually make the change the number of options that we're gonna do. Make sure you make a distinction between those two. Adding the ratio is changing the number of each particular leg. When you change the number of options, it's the whole entire trade. So here we go. So say for instance we had $300 in our account, we could probably do 10 of these, but let's just do five. So now we pay 160. That would be half your account if you had a $300 account. So let's review it. Profit and loss. See, so maximum profit is gonna be $80. Maximum loss is 170. That's a good play. And you're gonna be out of that trade in a week's time. Made $80. Maximum loss. But see, the thing is, you want to try to deal with a stock not like AT&T. You want to deal with one that's more volatile, that does a lot more changing. So, try to go, if you're going to do it for a shorter term, you want to go with a stock like a Tesla. You want to go with something that's moving a whole lot. Facebook, Teslas, Microsoft, things that have a lot of movement and stuff, a lot of volume and a lot of movement. So anyway, that's what I wanted to show you guys today. You know, just check out these strategies. I'm Marad, Mr. Cosmic at the Cosmic Trainer Academy, where we learn with you. And I want you guys leave in the comments. Tell me what you think about these different trade strategies and stuff. And have you been successful? Have you not been successful with it? I appreciate you guys. Um, until next time, check you later.